Randy, we had said before, maybe people could type in their answer, their
Yeah,
question.
let me go ahead and kick this off. Everyone on the line, welcome to the CIRI Critical Infrastructure Resilience Institute webinar series. This is a presentation today by our researchers at the University of Pennsylvania's Wharton School. As a way of background, CIRI, Critical Infrastructure Resilience Institute, conducts research at the nexus of cyber, physical, and human. And today's presentation will really focus on that human element, where what we hope to do is identify solutions that will help motivate behavior of humans who's making decisions through various market incentives which decisions will in fact improve critical infrastructure resilience. As a quick reminder, what is resilience? Of course, resilience is not preventing mishaps or disruptions, but it's reducing their probability, being able to operate through adversity and recovering quickly. That's really what we're trying to do. Today's webinar presentation will be about improving U.S. transportation infrastructure resilience through insurance and incentives. And obviously, transportation systems are very vital aspects of our critical infrastructure. Major disruptions to transportation networks can have very serious effects socially and certainly very significant economic impacts. We can't prevent natural disasters, obviously. But what we can do is look to risk management tools, including insurance and mitigation measures, to help reduce the impacts and recover more quickly when there are such disruptions. And so today's discussion will focus on that. The presenters today are Dr. Jeffrey Czikowski, who is the managing director of the Wharton Risk Management and Decision Processes Center at the University of Pennsylvania. And during his tenure there, he has served as the Willis Research Network and Travelers Fellow, conducting research on various economic and risk-related issues of natural hazards, as well as environmental impacts. Assisting him is Dr. Gina Tan, who is a postdoctoral fellow at the Wharton Risk Center. And her research interests include risk analysis, management for natural hazards, resilient infrastructure systems, sustainable water resources management, and climate change adaptation. With that, I'll turn it over to you, Jeff, to go ahead and give the presentation.
Great. Yeah, thank you, Randy. And you'll also notice there on the title that Howard Kuhnreither, who's the academic co-director of the center, he's heavily involved in this project as well. We actually have our annual sponsors meeting happening this afternoon and tomorrow, and so we're quite busy here with other things going on. So he sends his regrets. But for those of you who are on the webinar, any questions following from this can be directed to all three of us. And speaking of questions, I know we had said initially that people could type them in. I can just sort of say from my own experience in doing webinars, where I think there were a larger number of people involved. Since people have already chimed in, like Ray, it was nice to hear your voice. Feel free to ask questions as we go along. We'll try to pause. It'd be good to get some feedback. So with that, I'll turn it over to Gina, and we can start going through the presentation.
Okay, so as Randy noted, we're working on this project looking at U.S. transportation infrastructure resilience and how it can be improved through insurance and incentives. Some of the rationale for this project are that the cost of catastrophes and the associated government relief are increasing. As you probably know, the costs were pretty high associated with the recent hurricanes Harvey and Irma, estimates are in the range of 200 to 300 billion in economic damage, with only about 70 billion of that damage insured. During Hurricane Sandy, there was 75 billion in economic damage with only 30 billion insured. And this included 5 billion in damage to the New York Metropolitan Transit Authority, less than $1 billion of which was insured. And infrastructure is a large component of federal disaster spending. So in addition to, government relief funds increasing, just in general, the cost of catastrophes are increasing. This chart shows overall uninsured losses in the U.S., and you can see in general that both are on the increase. And some of the reasons for this are a higher degree of urbanization, a substantial increase in the value at risk, meaning the infrastructure or the built environment in areas that are prone to high levels of risk. Climate change and sea level rise also are contributing to an increase in the cost of catastrophes. And then, we also hypothesize that there's a lack of a holistic resilience framework to assess and manage risk, which is contributing as well. So just as recent as Hurricane Harvey, you can see as of October 11th of this year, individual assistance of 1.4 billion has been requested and public assistance of 500 million for recovery from that disaster. And I would assume that those numbers will go up as time goes on. So FEMA spends a lot of money on disaster recovery, with hurricanes being a primary source. About 57 billion in the years 2005 to 2016. Severe storms and floods and other disasters also require disaster recovery assistance. And if you look at the pie chart there, you can see that this assistance goes to different places, individuals and households, hazard mitigation, and to state and local governments. And a big portion, more than 20% of that, the funding that goes to state and local governments, is for infrastructure repair.
And not to put you on the spot, Matt Coates, but I'm just curious if you had any insight into maybe some, I don't know if you're privy to any of that, any updated numbers on the PA through FEMA, DHS at this point?
Jeff, I haven't seen any yet. I mean, we had done some collection of the situation action reports just to try to get our arms around the kind of the flow of the response as an indicator of, some indicator of kind of severity in terms of resource intensity issues. But I'm sure there'll be some retroactive analysis done. So to the extent that we can share that, I'm happy to pass that along.
Yeah, no, thank you. And I mean, we're just surprised, the IA number here we have on the screen is pretty heavy. And I know a lot of the impacts have been to individual property owners, but we're just trying to, obviously think about the critical infrastructure side of things with this project. So thank you for sharing that when you can.
Yeah, I think that, Jeff, just one more point on that. I think that there's been some expressed interest, at least from some of the academic partners, on understanding I'll call them third order, that may be mischaracterizing them, but the impacts on supply chains that are obviously affected from, if you look at geographical locations like Puerto Rico, where it's been pretty popularized in the news media regarding some critical medical supplies coming out of that area, and how that could potentially impact the total cost of such an event, and what that does to those organizations that are operating, those supply chains in that affected zone.
Right. No, that's interesting, and not to take this off on a tangent, but I think that's something we could certainly try to tackle in this phase 3 of what we're doing, which we'll come to later, where we're working with infrastructure managers like Amtrak. And we've had these conversations with them already, where it's not just the direct losses, right? It's these indirect losses, what you're expressing here in terms of supply chain, really trying to get your head around what those are and how you can sort of have metrics to understand how resilient you are to these losses. And I think even Steve Flynn's work, which he had presented back in October, sort of gets at that as well, where you have this sort of governance aspect where maybe you think like you're good from your silo, but you don't really understand the interconnections with other organizations. And so we're going to try to build that into our existing work.
So we chose to focus on transportation infrastructure rather than dealing with all infrastructure as a whole, to have some focus to the project. And the reasons transportation was chosen are that it's vital to the U.S. economy and way of life, responsible for movement of people and goods locally, regionally, nationally, and internationally. And transportation accounts for 9% of the U.S. GDP, with assets valued at $7.7 trillion as of 2012. And it's important to consider when you're thinking about resilience of transportation infrastructure that various transportation systems are owned both publicly and privately, and that the interconnectedness in these systems can be a source of both fragility and resilience. So as Jeff was just mentioning, it can be a source of fragility in that other infrastructure systems may be reliant on transportation. So interconnectedness can, cause a problem for another system if, your transportation system goes down. It can be a source of resilience because in some cases, different transportation systems are linked, and, one system can replace another in times of a outage or a disaster. So there are four main risks that transportation infrastructure is subject to, or four main sources of disruption, being natural disasters, failure of the infrastructure system, a major accident, or a terrorist attack. And there's an increase in risk associated with certain geographic locations, perhaps that are prone to natural disasters, aging or poor maintenance conditions of the infrastructure, and a lack of excess capacity or redundancy. And the extent of damage and the speed of restoration for transportation are critical determinants of how quickly a disaster-stricken area recovers. Here are a few examples of transportation infrastructure disruptions and their effects. So Hurricane Maria was already mentioned in Puerto Rico. As you probably know, there was heavy damage to the roads and bridges, and this damage really hindered the restoration access, for people and supplies to get to stranded residents. Another example that's transportation related is the Kobe earthquake in Japan in 1995. The port of Kobe suffered extensive damage, and the key issue here was that the slow recovery led to a loss of market share due to the disruption, and this had regional long-term impacts. Another example is a freight derailment in 2015 in West Virginia, where cars carrying crude oil derailed due to a snowstorm. And in this case, there was an environmental impact with oil leaked into a river, which then impacted the water plant. And another result here was a change in U.S. regulations for rail cars carrying crude.
So a few slides back, Gina had discussed this notion of having sort of this more comprehensive view of risk assessment and risk management, and that's essentially what we're getting at in this slide here. These different layers of risk transfer that are available to these infrastructure managers, and so and we talked about these four main causes to disruption. Now, of course, infrastructure managers face a number of different risks, right? Just risks to their own employees and people that are riding on the transit entities. But we're really focused on these catastrophic risks that can cause these disruptions directly or indirectly over time. And when you're thinking about these different layers of risk transfer, obviously insurance is going to be one key component. And so what we're seeing, we have these four sort of notions here on the right side of your screen. And unfortunately, it seems a lot of what has been thought about as a risk management approach is reliance on sort of a public sector backup through this disaster relief. And so the idea for us here is to be able to shift some of that up to these other layers of risk transfer through self-insurance or mitigation, the role of insurance, and then also the role of reinsurance or other alternative risk transfer instruments that are out there and that have been developed. And so we believe it's sort of a more comprehensive view. That we're not suggesting that everything should be packed into sort of these outside of the public sector backup, but that there should be some more distribution across these different things, that these have been weighed carefully in terms of what it is that the infrastructure managers are selecting. And so the project itself has gone through up to this point 2 different phases. And the overall idea has just been that we are interested in understanding from the insurance standpoint how this can be more readily applied and what barriers exist in terms of why it hasn't been to date, so that we're not seeing, again, these heavy public sector backup disaster relief aspect, but we have the insurance market coming in and playing more of an important role. And so the 2 different phases, one was essentially to first identify the different barriers and potential opportunities. And then we wanted to go into a little bit more depth in phase 2 on what we had identified. So a number of barriers that we had identified through the first phase of the project, which involved some conversations with the infrastructure managers and insurers, but also through the work that we do here at the center from an academic perspective. So one barrier was this notion of metrics that need to be available to evaluate and reward infrastructure resilience. We have some examples here. I'm not going to necessarily read through all of these, but another big barrier that we had seen is this notion of moral hazard associated with disaster relief. And the idea of this moral hazard aspect is that if you have people, you give people this notion that they're going to get some form of relief after the storm, after the event has occurred, it doesn't give them the incentive to do anything, or gives them the disincentive to not do as much, or to actually potentially put more of their assets in harm's way because they're not as exposed as they otherwise would be. And when we're thinking about, so Randy had said at the outset, this human component, right? And so a big component of this is just in terms of how people make decisions. That includes organizations and institutions and the people that run these the critical infrastructure, is how they respond to these low probability, high impact events, these catastrophic events. And there are all sorts of inherent behavioral biases in these. And so we're trying to also better understand this notion of risk perception and behavioral response as they think about making insurance purchases or other mitigation aspects. Of course, there's it can't just all be about sort of economic trade-offs, whether or not you're going to buy insurance, but there are also other political aspects. And we know that transportation managers are sometimes faced with budget challenges, just getting their system to be up and running as effectively as possible, not even withstanding the impact of these events. And then lastly, just what's the capacity within the insurance market to undertake more of this risk. So we identified these barriers, and the idea in that first phase, and then sort of the idea of the second phase was to get into more detailed conversation around these barriers with this focus on transportation infrastructure. And we wanted to do this through a series of interviews on both the supply and demand side of the equation here. So we talked to a number of insurers and also infrastructure managers. And from these interviews, and what we're going to highlight through the rest of the talk, is just what were the key themes, and then that came out of these interviews, and also what are we recommending as an outcome of that. And so the interviews that we had conducted basically through the spring of 2017 were with four for groups within the insurance industry. We had reinsurers, reinsurance and insurance broker, and a couple of insurance entities that we spoke to, and they were all dealing in different parts of the transportation spectrum, but those are who we had spoken to on the supply side, and then on the demand side of the insurance aspect, we talked to a number of other infrastructure managers. You can see here a number of ports, air, rail, transit. And so Gina's going to come back and kind of give you the results of these interviews that we had and how they coalesced around 6 key themes from our interviews.
Right. So in our conversations with the various people we interviewed, we covered a lot of different types of transportation infrastructure and, different entities from the insurance side of things. And so despite kind of the different roles of all of the people that we talked to, there were a number of topics that came up repeatedly. And so what we did was kind of synthesize the results of those interviews into these key themes, areas that we thought were important and were, repeatedly noted as important. So our first key theme is the need for better data. And so, many people noted that data availability and accessibility is important in developing new insurance products, in selecting risk management and resilience measures on the infrastructure side, and accurately pricing risk-based insurance. In the future, perhaps there could be multi-year or dynamic insurance policies, which might better justify, the financial side of spending on resilience measures, but these aren't really possible without, advancements in the data that's available. And I have on a few of these slides some quotes from people we talked to. And so an insurance broker noted that the cyber area is very new and insurers haven't developed the data for great modeling yet. So it's clear, that in certain areas, data and more data is needed. Another key theme is the need for resilience metrics. And you might have seen earlier that this was noted as one of the barriers that we identified in the first phase. So metrics are really needed for evaluating resilience measures. It's hard to justify implementing a resilience measure and the associated spending if there's not a way to measure the improvement associated with that measure. They're also needed to understand what insurance coverage types and amounts are necessary or important, and also to incentivize resilience through risk-based ratings and premiums. And we'll talk about it a little later, but metrics development is a key component of our ongoing work. In talking to a particular port manager, he noted that earthquake insurance premiums for their location are based on regional risk and are not site specific. And so basically what he was saying was that even if he was to implement earthquake resilience measures, his insurance premium wouldn't change because the insurance company didn't have a good way of measuring, the improvement that would be associated with that change. And so he had no incentive for doing mitigation measures for earthquake risk. He also noted that they got a waiver for earthquake insurance because the coverage wasn't economical. So again, this points out just the need for metrics to measure, to measure the effects of resilience improvements. The next key theme is reliance on federal funding. So we talked a little bit about moral hazard, where there's basically less incentive to implement mitigation measures or to purchase sufficient insurance, because of expectation that disaster relief will be coming. And every public infrastructure entity that we talked to indicated that they believe that the federal government would step in to provide assistance during a catastrophic event. In talking to some private infrastructure systems, we found that resilience improvements were more common, and there was less of this feeling of reliance on the federal government as an insurer of last resort. To give you one example of this reliance on federal funding, we talked to a transit entity, and they told us that for a future disaster, they'd expect FEMA to cover 75% of costs, as they did for 2 previous storms, Sandy and Irene. And this was factored into their decision making on purchase of insurance for catastrophic risk. They felt that once they hit a certain level of damage, that the federal government would step in, and so there's no need to have insurance above that level. Our next key theme is linking risk engineering and loss prevention with insurance premiums. So risk engineering is important in helping with understanding an infrastructure system's exposure to risk, taking loss reduction measures, figuring out which measures should be implemented, and in obtaining insurance coverage at an attractive premium. And insurers have risk engineering tools that can help pinpoint the most cost-effective resilience improvements. So in some cases, perhaps the insurers have different risk engineering tools or better risk engineering tools than the infrastructure managers. And so when those 2 parties are brought together, risk engineering can really make a difference with the implementation of effective resilience measures. Also, linking resilience to insurance premiums and coverage increases the incentive to undertake resilience improvements. So if an infrastructure manager sees that a resilience measure they would implement would result in lower premiums, then there's obviously more incentive to implement that resilience measure.
And so let me just add here on this theme, as well as the next one that you're going to see in a second, that this is also sort of getting a different view of insurance, so that insurance isn't just this policy that sits on a shelf until a rainy day comes along, but it's actually something that can drive the bottom line of the business or these transportation managers and help them proactively manage risk within their organization and realize the benefits to that. And so it's this, and comes back, some of this comes back to key theme number 1, so that the insurers themselves have the data that they need to work with to be able to do that. But it's kind of looking at insurance in a different way that maybe otherwise is thought about, so that it's a more proactive approach, and it's more than just this policy that sits on the shelf until something goes wrong.
Okay, so following along with that, our next key theme is insurance as a tool for resilience financing. So having the ability to finance resilience improvements is a key to reducing future losses. As we noted, a lot of these transportation managers, don't have extra funds. They barely have funds to cover regular operations and maintenance. So resilience improvements may not be high on their spending list. And we heard from multiple people that federal funding or loans typically don't cover 100% of their costs. So it can be difficult for infrastructure managers to justify spending given their limited budget. So even if, a federal grant for a resilience might cover 80%, they may just not have the remaining 20% or can't prioritize the funds to get resilience improvements put in place. So this was the case with a court we talked to that just said that, they have to have a board approve any expenditures, and they haven't used grant money for resilience improvements because the board wouldn't approve the additional funds, to go along with the grant money to get resilience improvements put in place. Loans for resilience improvements can be linked with reductions in insurance premiums. So perhaps, an infrastructure entity could get a loan, to put a resilience improvement in place, and the money to pay back this loan, might come from a reduction in insurance premium associated with that mitigation measure that they've put into place.
And let me just add to this as well, in the sense of, even outside of this project, right, for critical infrastructure, I'm sure many of you on the webinar here call for resilience. It's really important. We need to be more resilient. We need to do this. But then the big question is how you pay for it. And so, we're trying to link up this notion of insurance to help with the risk, with the resiliency financing piece, because this is a really big open question. Everyone knows that resilience initiatives are important to do, but It's how are you gonna find the money to get it done?
Okay, our last key theme is emerging risks. And emerging risks present substantial challenges because there's uncertainty and data unavailability, and these limit the insurance and the resilience measures. So there's several emerging risks that really were mentioned frequently in our interviews, one being climate change. So changes and risks associated with temperature extremes, storm and precipitation intensification, and sea level rise are causing changes to risk in various infrastructure systems, and there's uncertainty associated with that. So this affects setting risk-based premiums and also capital planning for infrastructure. So it's hard to make plans for the future when there's uncertainty about what the risk is going to be. Another key emerging risk is terrorism. So a lot of infrastructure systems have insurance coverage for terrorism through TRIA, which is the Terrorism Risk Insurance Act. But we've heard that this coverage is restrictive, and because of the restrictions, some infrastructure managers don't purchase this coverage. And the restrictions have to do with kind of which events are covered and the level of impacts that an event has to hit before the event's covered. We heard from a number of infrastructure managers that they are more concerned about insurance coverage and resilience for terrorism-like events. So events that probably wouldn't be covered under TRIA. The one type of event that was really frequently noted was an active shooter event, where an active shooter, interacting with the infrastructure system could cause, millions of dollars of damage very quickly, but this, generally wouldn't be covered under TRIA. Another key emerging risk that we talked a lot about with the people that we interviewed was cyber risk. The number of cyber incidents is increasing sharply, as you can see in this chart here. This is data that was supplied by Jay Kesson, who we've been working with on this project in talking about cyber incidents and cyber risk and insurance in that area. You can see that there's been a pretty rapid increase in transportation-related cyber incidents just over the last 20 or so years. There is cyber insurance available, but the coverage is limited, and this goes back again to some of the data issues that we've talked about. Insurers are hesitant to provide extensive coverage when they don't have a great understanding of the risk. The tools to assess cyber risk are still under development. And another thing to note is that cyber risk differs from other risks in that a single cyber event could impact infrastructure globally, unlike, say, a hurricane, which impacts one geographic area at a time. So this is a different type of risk that insurers have to consider, wherein they could have a lot of claims all at once from different locations. Okay, so now we're going to move into some recommendations based on the barriers that we identified and the key themes that we identified in the last phase of work. And I have these key themes noted here in the circles, and you'll see that we're trying to tie these recommendations to these key themes so you can understand how they relate. And so our first recommendation is to continue working toward revisions of the Stafford Act. And so, the Stafford Act authorizes disaster recovery expenditures by the federal government and plays a part in that moral hazard that we've talked about a few times already. So we feel that it's necessary for the government to be the insurer of last resort, in a truly catastrophic event. Infrastructure systems need to be able to recover, in order to facilitate community recovery. And so there are cases where the government needs to step in, but adjustments to the Stafford Act could address this moral hazard issue. Some adjustments that have been suggested are implementing some kind of deductible prior to an infrastructure system getting public funding. There also could be stricter insurance requirements about purchase before or after an event. And so we feel like this could encourage improvements in resilience, it could encourage improvements in insurance coverage, and reduce reliance on government funds. Our next recommendation is to promote alternative funding vehicles for pre-event resiliency investment, including those linked to insurance. Again, this ties back into the need to finance resilience measures, with infrastructure managers struggling with operational maintenance funding and not being able to find longer-term funding for resiliency efforts, at least not pre-event. So we feel that insurance-linked securities or low-interest government loans could be used to fund resilience measures, and that the affordability of resilience improvements could be enhanced by a reduction in insurance premiums associated with the resiliency measure where applicable. Our third recommendation is to facilitate catastrophic risk data collection, availability, and analysis. As noted, there's difficulties in relating resilience improvements to insurance premiums. There's a need for quality data acquisition, sharing, and analysis to quantify the benefits of these resilience improvements. And, you know, we heard from the insurers and the infrastructure managers that they can't manage and synthesize the data that they need since it spans multiple entities. So, you know, particularly on the insurance side, you know, individual insurers have data from claims that have been filed with them, but they're not generally able to access information on a wider scale, you know, that involves other insurance entities. And the need for data is particularly critical for cyber risk.
Let me just add on this really quickly. I mean, for our DHS partners on the line, right? I mean, this is probably something you've heard in regard to, say, the flood insurance market, opening that up to more private insurance, and the fact that the majority of NFIP policies, National Flood Insurance Program policies to date, are underwritten by the U.S. government, and there are a number of insurers and catastrophe modelers have been asking for that data for years. And so in thinking about how better data collection, I think this is really important to allow for more private market participation.
Hey, Jeff, a quick question for you. For the TRIA Act a couple years ago when it was signed and re-upped, as part of your analysis and interview, did you get any different sense from those that you interviewed of what their understanding was? I think that there was a total loss. The bill talks about when the certain federal resources kick in, and I think that one of the most recent bills actually changed that figure, so the government would kick in at a much higher rate of actual losses. You know, wouldn't come in at the level that we typically come in at. I think it was maybe around $100 million, and I thought there was an increase, almost maybe doubling of when TRIA would actually kick in. Did you get a sense of that? Because I almost view that as an indication of how the government's viewing that particular act.
Well, I don't think that the people we talked to specifically noted that change, but you know, it was particularly some of the infrastructure systems that were not in big cities. You know, they noted that there's no way that an event that impacts their infrastructure is going to hit whatever the, you know, whatever that limit is, the 100 million or whatever it is in damage. So, you know, they felt that it just wasn't even worth purchasing it. You know, that the kind of events they would be subject to, you know, might be catastrophic for them, but aren't going to hit that limit. So, you know, whether it's a change in TRIA that's needed or more private insurance options that are, you know, specifically geared towards, you know, an individual infrastructure system, you know, in either case, there's this risk that that certainly could be better insured.
Okay, thanks.
Okay, our next recommendation is to encourage the development of risk transfer and resilience metrics. So I think we've talked about this a lot already, but metrics on system characteristics and maintenance would assist with risk-based pricing for infrastructure systems. Financial and insurance metrics would assist infrastructure managers in assessing financial readiness to deal with catastrophic disruptions and with evaluating the need for resilience measures and insurance. And so this second bullet here is what we're working on in our current phase of the project. So we're currently working to develop these financial and insurance metrics that can be used by managers at infrastructure systems to understand how they're doing with financial readiness.
Just one other important aspect to this too is, again, this sort of a focus on the financial and insurance and the risk management piece. And even some of our conversations with with transit managers, they had gone through a whole series of assessments on resiliency, but that piece of the pie was never really brought up. It was a lot of this was emphasized on the physical side of resiliency. And so, and this is for us as the Wharton Risk Management and Decision Processing Center, this is sort of our, what we focus on. And so we're really trying to highlight that in terms of this metric development.
Okay, our fifth recommendation is to support research pertaining to emerging catastrophic risks. So the uncertainty and the data unavailability associated with these emerging risks really does limit insurance and resilience measures. And as I noted, cyber, terrorism, and climate are some key emerging concerns. And our number 6 recommendation is to consider a redefinition of terrorism for coverage under TRIA. So I think, again, we've talked about this, but TRIA coverage only applies to events that meet certain thresholds and are deemed as terrorism by the federal government. And, a number of infrastructure managers indicated that this definition just doesn't, isn't really applicable to them. So the events that they're most concerned about wouldn't be covered. So for instance, the Boston Marathon bombing, damage associated with that was not covered, I believe, because that event didn't hit, the limit for total damage that needed to be hit for, various entities to be covered. So either broader coverage under TRIA or private insurance for terrorism-like events, I think, is important. Some infrastructure managers we talked to did have, kind of certain policies tailored towards the individual risks that they're concerned about, but others do not and are just not covered for damage associated with terrorism. Recommendation number 7 is to inform infrastructure managers of the comprehensive operational benefits of catastrophic risk insurance coverage beyond a straightforward loss backdrop. And this comes back to what Jeff was mentioning earlier, is to really get infrastructure managers to understand that there are benefits to insurance other than just a policy that's there, in times of a disaster, that there are other benefits that they can see with working with insurance. So in addition to financial security, insurance provides benefits associated with comprehensive risk modeling and assessment, and access to other risk transfer financing mechanisms. And these benefits have the potential to significantly improve resilience of infrastructure systems in the U.S. And on this slide, I kind of have a different view of these recommendations and the barriers that they address. Earlier on in the talk, we talked generally about barriers. I have them here kind of described from the infrastructure perspective and the insurance perspective. So infrastructure managers are concerned with funds to implement resilience improvements. They're concerned with data for risk assessment, with evaluation and prioritization of resilience improvements, and protection from emerging risks. And so you can kind of see here which of the recommendations address each of those barriers. on the insurance side, key concerns were data to support risk assessment for emerging risks, cyber in particular, metrics to evaluate resilience improvements, demand for new products. And this can tie back partly into the moral hazard associated with disaster relief, where they feel like that might hinder some of the demand for new products that they would offer. And then the ability to offer new products, including things like real-time insurance and coverage for emerging risks.
So, this is just sort of one view of how you can think about these. We have 7 recommendations, but which of these is most critical? And if you're trying to break down a number of barriers, if that's sort of your goal, then it looks to be recommendation number 3. You can look through the rest to figure out the descending order on that, but it doesn't necessarily mean that recommendation number 3 is going to be the most impactful in terms of breaking down, say, the most significant barriers, just the number of barriers, but that's something that we hope to flesh out a bit more in the ongoing phase of the work.
Okay, so our key conclusions are that there are barriers to improved infrastructure resilience and insurance for catastrophic risk, but there's also opportunities. And we think that the recommendations that we developed would help to address the barriers and to promote a robust insurance market and resilience for infrastructure. And some of the things we're currently working on and plan to work on in the future are these financial and insurance metrics for infrastructure resilience that we discussed, and also additional work on cyber risk perception and insurance. As noted, cyber is a key emerging risk, and we heard a lot of concern about cyber risk from both infrastructure managers and insurers. And we appreciate you taking the time to listen to us talk about our project. If you want more information, we have a number of different resources on our Risk Center website. There's an issue brief that summarizes what we've discussed today. We also have a couple white papers. And then also you can see our email addresses are there if you want to contact Jeff or I or Howard for additional information.
And let me just close with, we send the brief and the white papers, we send them out to everyone on our distribution list at the center. And I can just say, especially in regard to the brief, we've gotten a lot of good positive feedback on what we had put together, some of the things that we had highlighted in the talk today. So that was encouraging from a lot of our insurance industry sponsors.
Yeah, thank you, Jeff and Gina's a great presentation. And I think it hopefully it points out that your project is really a very key research project for us here at CIRI, because it's helping us to validate one of our key mission areas, which is to try to help build the business case for greater investment in security and resilience. I think you've demonstrated that the issue of market incentives as a motivator of business decisions, if we can in fact make create some of those incentives or enhance some of those incentives, I think it impacts multiple companies and multiple industries and multiple sectors. So this particular mission area, research area, could give us a significant impact in the market. So we appreciate the work that you're doing and appreciate your presentation today. Thank you.
No, thank you.
Anyone on the line have any questions or comments they'd like to make?
Yeah, this is Ray. Very nice presentation. I just think it's extremely challenging to evaluate this public-private push-pull. Who pays the bill? I mean, the private sector may want to see more public support, especially when a catastrophe arises that wasn't expected, and the government wants to see more private support in the form of insurance and market, building resilience. It's just a comment.
Yeah, no, thank you for that, Ray. I mean, I would just sort of, and I was trying to allude to this on that slide where we talked about the different layers. We're not suggesting that any one layer is better than another. We're just suggesting that it's important for these infrastructure managers to go through a process of weighing the trade-offs of what these different layers are. And we do see evidence of that in our interviews, right? They're not just sort of saying, oh yeah, we're going to get relief. I mean, they've gone through, sort of a decision-making process on that, but we're hoping that it's just a framework we're developing, especially for the metrics, is going to allow them to do that in a more informative way.
Yeah, right. No, I see that.
Hey Jeff, this is Matt and Gina. Just again, I'll reiterate. Thanks for the presentation. Are you aware of any technologies or tools? I know on that matrix you identified new products on the bottom, and understanding you're in part talking about insurance products. But obviously, as a science and technology directorate, we're in the mode of identifying tools or emerging technologies that would give maybe one of these small businesses, medium-sized businesses that may not have the resources to justify the resilience types of investments. But are you aware of any methods or tools currently available on the market that would help give some visibility into risk posed by, say, for example, supply chain? So you kind of brought up in the beginning, the idea that, I had brought it up, that you could be geographically removed from a large-scale event, but you could be unwittingly affected by the lack of the transportation network to, let's say, get you products or some other form of services. And so that in itself would represent a catastrophic loss for that entity. If they effectively don't have that data, they would never know necessarily what they're relying on in the form of more or less public infrastructure. So would you characterize that under that one action? I think it was a data availability. It might have been 3 or 4 recommendation. And are you aware of any of the tools that would help somebody do that kind of assessment?
So no, I think that's a good point. And as we, again, in this next phase of the work, especially through the case study that we're going to be doing, I think that's something that we'll definitely try to highlight. I can kind of speak to our experience in terms of technology tools in regard to our relationships with catastrophe modelers. And some of this came out in the interviews that we had with the infrastructure managers. So yeah, these catastrophe models are out there, but they are very expensive to implement, right? And so I think it's not only sort of the data side of it, but so the data can improve the development of these catastrophe models. But to your point, Matt, not everyone's going to be able to afford to use that. And so we've also sort of talked about the development of maybe more publicly available catastrophe models that then these other entities that might not be able to afford the advice from these catastrophe modelers or would be able to use that. But that's, one thing that we came across. Off the top of my head, I don't have anything that's jumping to mind in terms of different tools outside of our experience with CAT models, but it's something we can certainly try to hone in on in the ongoing phase with the case studies.
Okay. Thank you. Appreciate it.
Any other questions or comments?
This is Sachin Shetty. Thanks, Gina and Jeff, for a great presentation. The comment or question that I had was on the recommendation number 3. I was wanting to know, based on your interviews, whether there were any concerns with regards to sharing the data. Just for an example, if, let's say, somebody wants to report an attack or an exploitation of a product or a device that's attributed to a certain vendor, did they have any concerns of how best to share the information so that that the information is shared, but the privacy is protected? Are there any concerns expressed on the management piece, not just on acquisition of the data? So let's say we do get over the hump of acquiring the data, but what would the best strategy to make that available more from an analysis standpoint, but hide away the specific attribution?
Right. So, I mean, it's a critical piece, and I was trying to address this as we were talking about that. I mean, again, we work with a lot of insurers, and this is always, I would say, insurers don't really like to share their data, right? And the big reason for that is part of it is they feel it's their comparative advantage. And to your point, though, I mean, does this lead to sort of if you're sharing this data, does it lead to, other exploitations of the system? And so I think this is something that's really needs to be thought about. And I'll come back to also what I said about the NFIP, and the data sharing there was all about sensitivity to individual homeowner data concerns. And so it's until we can kind of climb over that barrier, right, it's going to be difficult to be able to have the data out there that you need to be able to attack these problems. And so I think that's something, again, from what Matt was just saying from the S&T side, how can you sort of develop these systems that allow for data sharing that people feel comfortable in participating in.
And I think the answer lies in the metric, I believe, and finding out, it's the least amount of data that you need to,
right,
or the optimal amount of data to get the metric that will help you get to the next stage, and balancing the two, identifying how much information, instead of saying what data, how much information you need to get to the metric, or help you. Yeah. Because the whole purpose is to get meaningful metrics.
No, that's a good point. I mean, the question I would raise is, sometimes when you're dealing with government-oriented data, can you really go down that road? Is it, is it sort of just different pieces of it, or is it all or nothing? But Gina, I don't.
Yeah, well, I was just going to add that, when we were doing our interviews, one of the questions we asked at the end was kind of, we told the people that were working for DHS on this project, and what could the government do that they would find to be really helpful and effective in improving this issue. And quite a few people mentioned data collection and data sharing, and I think some insurers even mentioned that due to like antitrust regulations, they can't always share their data. And so, this really seemed to be a key area that they were looking toward the government to help with, an area that perhaps DHS could address.
Thank you.
Okay, well, we've concluded our time. We used up all of our time. Thank you very much. Again, for those interested, our next webinar will be on January 25th. At 1 p.m. Central, and it will be Jason Jaskalka, who is an assistant professor up at Carleton University in Ottawa. He'll be discussing how to identify and analyze implicit interactions in complex systems used in critical infrastructure. And one last time, again, Jeff and Gina, thank you very much for a great presentation. Really appreciate it. Thanks everyone for attending. We always appreciate that. Cheers, all. Bye-bye.
Thank you. If anyone has any questions, feel free to email us.
Yeah, great. Thank you.
Okay. Bye-bye.
Bye.